with the prospect of U.S. interest rates falling, the U.S. dollar, probably seeing its peak, I think that we're going to see, more gains in gold prices. But it's not just that; it's also the possibility of a deeper correction in stocks. September is historically one of the worst months in the stock market. August is neutral to slightly negative. July tends to be a really good month for stocks, and we saw that. So we're moving into a period where equities are vulnerable, and when equities are vulnerable, that tends to be really good for gold.
Hi, and welcome to Wealthy On. I'm James Connor, and today my guest is Kathy Lien, and Kathy heads up foreign exchange at BK Traders. And we're going to hear Kathy's views on the US dollar, gold, and the economy. Kathy is also a very prolific writer, and she just finished another book, and she's going to tell us about it. Kathy, thank you for joining us today. How are things in New York?
Things are great. Yeah, it's hot as it is everywhere, but we're enjoying the summer.
Yeah, I am in Toronto. It's also very hot and humid here, but thank goodness we have air conditioning, unlike the poor athletes in Paris right now.
That is very true.
I don't know if you heard, but they were trying to make these Olympics more greener and sustainable, so they don't have air conditioning. A lot of the athletes had to bring in their own air conditioning units.
What's really funny? I was just in Japan, and we were talking earlier about how it was basically 110 degrees in Japan, and they had a lot of outside workers. And what I found really interesting is that all of the outside workers wore these bubble suits, and these bubble suits had a fan inside them. And I thought it was brilliant. And I feel like the Olympic Games athletes should be wearing their own bubble suits so that they don't have to suffer through all this.
Oh, wow, that is crazy. I'm going to have to look that up at the conclusion of this interview. I've never heard of such a thing. Well, let's get on and talk about the markets now. There's so much happening this week, and it's another big week for earnings. Over 30% of the S&P is reporting this week. We have another Fed meeting coming up. We have the non-farms coming out on Friday, and I'm looking forward to seeing what that unemployment number is going to be. So there's a lot to discuss here. And I want to start with the economy. We recently saw the Q2 GDP number come out. It came in quite high at 2.8%, much stronger than Q1, which was 1.6% after a revision. And I want to hear your views on the U.S. economy. Do you think it's heating up again?
That's a really good question because, I don't necessarily think the U.S. economy is heating up. Again, we see a lot of retailers warning about consumer demand in the future. We see McDonald's, most recently reported and how, they we're worried about demand as well, especially for, I guess, high ticket items. McDonald's burgers aren't that cheap. And I guess the Big Mac prices are rising and they're worried about the response to that. But what really is interesting, though, is that while these retailers are warning, as you said, in the GDP number, and as well as in some of the earnings reports that we've seen, there hasn't been as much downside surprise. Yes, these firms are worried about what consumer demand and economy could look like 3-6 months down the line. But so far, we haven't seen that retrenchment, that and broad-based retrenchment that everyone is so worried about.
Yes, very interesting points, especially about McDonald's. I mean, if people don't want to spend $5 on a meal at McDonald's, like they must be hurting. And I did read in their last quarterly numbers, it did say that the $5 meal plan only kicked in the last 3 weeks of June. So it's going to be interesting to see how things
I
progress.
think it's just a matter of time, though. I sincerely believe that we haven't seen the jobs report soften as much as everyone expected. Yes, jobless claims have perked higher, but we've seen also counter data in the JOLTS and other reports. And I think non-farm payrolls, as you mentioned, is coming up. And even if we get something below 200,000, 1 month of softer numbers is not necessarily going to convince everyone that the labor market is weakening enough to justify or to reflect a significant slowdown in the economy. Everyone's painting the doomsday scenario, talking about how, if we have a major increase in the unemployment rate above a certain amount, that, has historically signaled that a recession is coming. But so far, as much as we may be worried, and I still am, we really have to see the numbers. And I think what we are actually seeing, though, is that companies are preparing for it. either both mentally as well as physically. They're taking initiatives to limit hiring. They're taking initiatives to cut their belts. We see it in the ISM numbers as well. Services, manufacturing ISM numbers have also been softer. So we really just need to see it in the labor market numbers, I think, to really cause panic in the markets. And speaking of the markets have not crashed either. So as long as the markets remain lofty to some degree, I mean, it's certainly no longer making new highs. But as long as it remains lofty, then you're not going to see that business and consumer sentiment crater as much as we think it should. But I still think, we're just biding our time, and that the slowdown that the Fed is warning about is coming.
And so I just want to clarify one thing: the 2.8% that we saw in the GDP number, you think that was just a one-off or an aberration?
Well, GDP is backwards looking, right? So I think that, yes, we had a good quarter. I think that the next quarter is going to be tougher just because I think, you're going to see a lot of effects of the economy being shown in the consumer data as well as in the manufacturing data going forward. So yes, I do believe that we're going to see slowdown in growth, and that's really what the market's banking on. It's really what traders are banking on. It's really what the Fed is banking on as they signal a September rate cut.
And I want to ask you about the price of oil now, because it's been hanging in between $70 to $80 a barrel. And there's a lot of speculation as to why it's still so low. And some people are saying it's because of a slowing economy, a global economy, and a slowdown in China too. And others are saying, well, it has to do with manipulation going on with the Biden administration, right? They're selling more oil into the global markets, and that's keeping the price down or suppressing the price. Do you think? Well, what are your thoughts on the oil price here?
I think that the slowdown in China and their lack of real substantial stimulus is playing a very big role in the pressure that we're seeing in oil prices. They this month they had their third plenum, and traditionally, what this big meeting, the third plenum, these plenums are supposed to provide is the platform to announce major stimulus packages. And the Chinese government fell short of that. There was a lot of expectations going into this meeting. And even though they, see all of the red flags, they see their economy slowing. For one reason or other, they have not decided to come out with that major fiscal stimulus package that the economy needs. So, stock markets have been disappointed. Oil markets have been disappointed, and investors have been disappointed. So I think China plays a very large role in this. And yes, they came out later on and they, kind of reduced, some of their interest rates on the short term and long term basis. But it's not the on the ground fiscal stimulus that is needed to really jumpstart the economy. So I think that combined with the fear that the US economy is also slowing, so it's a reality that China's slowing, along with the fear that the US is slowing, I think are playing the biggest role in the pressure on oil. Of course, all the thoughts around what the Biden administration doing is not helping either, but I think the bigger story is really global growth at the end of the day.
I want to ask you about inflation now. This whole move in interest rates that we're always talking about is predicated on inflation moving down toward this 2% target rate. It's currently around 3%. What are your views on inflation? Do you think the Fed is getting it under control, or the government is getting it under control?
I think no one is really getting it under the control, because we don't just see it here in the US. We see it in many corners of the world. I mean, we have a Federal Reserve meeting this week, but we also have Eurozone inflation data. And that's kind of clue as to what inflation is around the world. And just as hard as they may be, and they have been more aggressive in the monetary cycle, just as hard as they may be trying to fight inflation, inflation actually beat expectations in the latest report. And I think that this is the struggle that the Federal Reserve faces as well, which is, they may be leaning on the weaker US growth in driving inflation lower. They may be leaning on the stronger US dollar in driving inflation lower. And inflation has been lower, but they have certainly not gotten in control of this yet. And that's why they've been so resistant to cutting interest rates for such a long time. And I think that's going to continue to remain the story, because I believe that, right now, they're not confident that the trend of inflation is going to continue to move in the right direction by the magnitude that they need to offset the effects of a interest rate cut. And they have to be really careful with that.
As you just mentioned, the U.S. is hyper focused on getting the inflation rate down. But other countries, Canada, for example, and also in Europe, they have cut interest rates. And once again, they're more focused on growth as opposed to inflation. So inflation is still running quite hot in Canada, but our Bank of Canada has cut interest rates twice. Do you think the U.S. is making a mistake, or do you think the Fed is making a mistake by not getting on top of this and not cutting rates?
I think that they know they need to lower interest rates. And I couldn't say that they're making a mistake right now, because so far the data hasn't weakened as much as the Canadian data had, for example. The Canadian labor market numbers had softened quite a bit. And we'd seen also softness in retail sales numbers. Eurozone has been depressed for some time. And actually only now we're beginning to see a little bit of stabilization. But this morning we had the German GDP numbers, and it showed a surprise contraction in the last quarter. So they are facing more critical weakness in data. So they're facing more critical weakness in data, whereas the US, the data is still kind of mixed. And so as a result, I think, they have the luxury of time to really, to handle this.
And so we got to talk about the Fed that's going to come out with a report this, I believe, on the 31st. I guess there's a 5% probability that they might cut, and there's a much higher probability they're going to cut in September. What are your thoughts?
I think that they're sending a very clear message that they're going to lower interest rates in September. And I think in their eyes, so the data that they've seen so far justifies the interest rate cut, because we are seeing a bit of slowing in the economy. Now, the question is, if they cut in September, are they going to signal more to come, or are they going to take a back seat and indicate that they continue to be data dependent, basically try to diminish the impact of the interest rate cut? And I think that could happen. Now, we still have quite a bit of data. We have another inflation report. We have the non-farm payrolls report before the September meeting. Actually, we have two non-farm payrolls reports before the September meeting. So we have the luxury of seeing, and the Fed has the luxury of seeing, whether that slowdown in inflation has really persisted, and whether the slowdown in the labor market is continuing. Now, if we do get some upside surprises in the non-farm payrolls report or the CPI numbers, there could be more of a hawkish cut than what the market really wants to see.
This show is sponsored by BetterHelp. To feel my best, there's two things I do on a regular basis. I work out with a personal trainer, and I meet with a therapist. Working out keeps my body in shape, but working with a therapist keeps my mind in shape and keeps me thinking in a positive manner. Life can be crazy busy with family and work commitments and managing your investment portfolio and just so much more. With all that, it's hard to fit in time to relax and have some fun. That's why it's important to keep your mind fit and focused as much as possible. Therapy can provide you with the skills which allow you to manage stressful situations more easily. If you would like to speak with a therapist or give it a try, consider BetterHelp. It's all online and fully flexible according to your schedule. Never skip therapy day with BetterHelp. Visit betterhelp.com/wealthyon to get 10% off your first month. That's BetterHelp, HELP.com/wealthyon. Now back to the show. So I want to talk about foreign exchange now. That is your focus, and I want to get your views on the U.S. dollar and the U.S. dollar in relation to other currencies. And I guess the U.S. dollar has been relatively strong. Now, Trump, he's out campaigning, and in one of the policies he's saying he's going to implement if he becomes president is that he's going to weaken the U.S. dollar and therefore stimulate manufacturing at home. And I want to get your views on that.
Yes, I mean, I think that is one of the greatest potential impact if he wins the election, which is that unlike Biden or some other presidents who have stood steadfast to the U.S.'s strong dollar policy, Trump as well as Vance have been quite clear that they support a weaker dollar. And so, there is, while the president doesn't have a direct impact on, dollar policy, and, the direction of the dollar is much more contingent upon where interest rates are headed than trade policies, especially near-term trade policies. I think, as a result of the election outcome, if Trump wins, that we could certainly see a knee-jerk decline in the dollar. The dollar's had a really great run in 2024. We're nearing the election, and I think that you're starting to see an unwind in the greenback. And if we do see the polls show a clear Trump victory, that could also facilitate a further unwind, especially if it is tied with a Fed easing cycle. So I think that the landscape that we're seeing on a political as well as economic and monetary perspective does start to favor dollar weakness in the second half of the year.
Yes, and you are correct when you said it's all driven by interest rates, and that's what we're seeing in Canada right now because our bank has already cut rates twice. So the value of our currency is going down versus the U.S. dollar. And I can't even afford to go to the U.S. anymore. I got to mortgage my house to take a trip to the U.S. It's crazy.
Yes, and that's why I'm headed to Canada in a couple of weeks, because for Americans, it's been such a great deal. As I said earlier, I was just in Japan, and not only is the currency 14% cheaper than where it was a year ago, but on top of that, you get a 10% duty-free refund. So in essence, and the duty free, I think the minimum for charge that you get the duty free refund is $33, which is basically nothing on a regular purchase. So tourists are spending significantly, and Americans are traveling all around the world. And I think that that this is going to come to an end. So, Americans, if you got an opportunity to travel, definitely get out there.
Yeah, and just as a reminder to our American viewers, when I go to the U.S., I got to pay $1.37. Okay, so I'm effectively paying 37% more for everything in the U.S. And of course, when you come to Canada, it's going to be that much cheaper. So now you mentioned Japan. Let me get your views on Japan because I think most people know the Japanese stock market has been making new all-time highs. It's taken 40 years to take out the highs that we saw in 1989. So I'm curious as to what's happening within that country, what's happening with the economy, and maybe you can also speak to the currency.
Yes, so it's all interrelated. And that's really the great thing about markets, which is that the reason why the Nikkei has done so well is because the Japanese yen is so weak. And so that's really facilitating a lot of demand for Japanese goods. There have been a lot of retailers like Burberry and Kering, which owns Gucci, basically report a decline in sales all around the world except for Japan. And that is single-handedly due to the weakness of the Japanese yen. Of course, Japan is also coming out of a very long period of stagnation. And there's been a lot of investment into the younger generation. Japan is everyone knows that Japan is a very old culture of elderly people. And, it's got a very old population who've been in the workforce for a very long time. And a lot of them are starting to retire. And so the government realizes this, and they're spending money investing on startups, investing in the newer generation so that they can revive the economy when it happens. So all of it is interrelated. And, we are seeing a resurgence in many countries like Canada and the US. Retail sales have been mixed. They haven't been that great. In Japan, retail sales are really picking up. They also have recently, their labor unions have negotiated wage increases. And it's been a long time since we've seen wage increases in Japan. So that is also translating into domestic demand. So we are seeing, significant changes in Japan's domestic economy and, the attractiveness of, Japanese goods at the same time, making the Nikkei, as high as it is. So it is all interrelated because a large part of that is also due to the weakness of the Japanese yen. I want to add, there was a very interesting, I was talking to, some businesses out there. It was a very interesting story that one of the businesses told me, which is that for a very long time, as many people may know, Japan has struggled with deflation. meaning that prices have been falling. They've been unable to raise prices. And a lot of that is due to culture as well. And he told me that about 8 years ago, which is a long time ago, there was a candy company that raised the prices by 10 yen, which is the equivalent about 6 or 7 cents. And they had a press conference. All of the employees bowed in apology. And it was a really, really big deal. Even in February of last year, when another company, similar candy company, tried to raise prices, they released a really remorseful press release about why they had to do this. Nowadays, there's no excuses. They just raise prices, and the excuse is the Japanese yen, and they don't even think twice about it. And this is a significant shift in the culture that is leading to inflation rising, that is helping the general economy improve because it's allowing for wage increases. It's allowing for prices to no longer hold at these low levels. And when these big businesses are actually raising the prices, it allows the small folk, the mom and pop, sushi shop that's on the corner, and to also raise their prices. And so this is the right direction for a lot of these businesses and the economy. And it's a shift that we're just beginning to see this year. And this weak yen is giving them an excuse to do so.
Now, I've never been to Japan. I would love to go, but if I was going to go to one city in Japan, what would you suggest?
Well, Kyoto is quintessential, I think, historic Japan. It's absolutely beautiful. But if you want the buzz, Tokyo is where it's at. It's really hard to say. I was there for 2.5 weeks, and it was barely enough time to scratch the surface of the major cities. But it's a truly beautiful country.
And I love sushi. Is the sushi much better in Japan than it is in North
It
America?
is. And not
Oh,
only that, there are so many places that are 100 yen for a plate of sushi, which is basically 75 cents. And, it's the freshest sushi that you can get, and 75 cents a plate.
wow. I'm definitely going to have to do a trip there. Okay, I want to move on now, and I want to get your thoughts on gold because we can't talk about the US dollar without discussing gold. And there's a very strong negative correlation between the US dollar and gold. Gold is still up, I think, around 15% on the year, and this move is once again predicated on lower interest rates, which will result in a lower dollar and a higher gold price. But I want to get your views on gold right now. What are your thoughts?
I think that's where it is. It's exactly what you said, which is that with the prospect of U.S. interest rates falling, the U.S. dollar, probably seeing its peak, I think that we're going to see, more gains in gold prices. But it's not just that; it's also the possibility of a deeper correction in stocks. September is historically one of the worst months in the stock market. August is neutral to slightly negative. July tends to be a really good month for stocks, and we saw that. So we're moving into a period where equities are vulnerable, and when equities are vulnerable, that tends to be really good for gold. And so I think going into September, a little less August, but more into September, we should see more demand for diversification as investors look at interest rate cuts, they look at slowing growth, they look at the weakness and the lack of return in equities, and they turn to gold for diversification.
And I got to ask you about the central bank buying because this is another reason why it's been moving higher. But in 2022 and 2023, 25% of all gold production has come from central banks. And I guess my question to you is, do you think the central banks are keeping prices artificially high by acquiring it so aggressively? Because when you look at the gold equities or the gold mining stocks, they're not pricing in $2,400 gold. The price they're factoring in is much lower, like 16, depending on the stock and whose research you're looking at, it could be anywhere from 1600 to 1800.
I think absolutely. Central bank buying has been one of the greatest supporting factors for gold, and I don't think that that's going to change anytime soon. I think the political landscape and who becomes the president for the next 4 years is going to affect that, as well as U.S. international relations, start to affect central bank buying. But for the most part, I think a lot of countries around the world, especially the ones that don't have the most favorable relationships with the U.S., have seen a good reason to diversify out of US dollars. And if they see the landscape and they see that the dollar is potentially weakening, which, before they may feel like it's more FOMO or they're missing out on the strong dollar rally, now they're seeing the Federal Reserve is stepping up to the gate and they're lowering interest rates and there's diminishing returns in the greenback. That may give them an even stronger case to diversify into gold.
So I want to ask you about your YouTube channel, and just so the viewers know, you have a YouTube channel. It's called BK Forex, and on that channel, you interview a lot of traders across many different asset classes. And I'm curious, when you talk to all of these traders, is there a consensus on how they feel about the S&P and the Nasdaq right now in terms of valuations or about the economy?
Well, we don't yet interview traders for our YouTube channel. Our YouTube channel is focused on, providing trading tips, trading strategies, talking about the markets. I did a couple of videos on what's going on in Japan. Also talking about, how to trade and, different opportunities. We will be putting up trader interviews in the future, but not at this stage. I do talk to traders a lot every single day because, I'm in the market and we have a lot of clients that are active traders. And a lot of them, quite honestly, are day traders. So they're much more interested in the short term opportunities in the market. Now, what's interesting is that even though most of them are day traders focusing on the charts, on technical analysis, they're always coming to me asking me about what you're saying, which is, overall, what is the direction for the markets? What's the big story? What's the economic outlook? What's the data? And I think that reflects their concern about what is the outlook for the U.S. economy, and they're concerned about the durability of the previous S&P and NASDAQ rally, whether or not we're going to see the NASDAQ fall further. And they're using this as context to lean heavier into one trade versus the other. And as, traders, we are all, fully aware that bear markets, are much more aggressive, quick and steep and deeper than bull markets, which take their time. So as we move into this phase where we could potentially be moving into a period of slippery markets that can be, pretty risky to trade. I think that, everyone's trying to think about the way to strategically place their entries and exits in order to take advantage of that.
And you're also a very prolific writer. You've written many books, and you have a new book coming out here in a few months. Tell us about that book. What's the topic?
Yes. So I have just finished my sixth book with John Wiley and Sons. And so, when my books are written, usually they're sold on Amazon and Barnes and Nobles at the airports, and they're translated into many different languages. This latest book is called Prop Trading Secrets: How Successful Traders Are Living Off the Markets. There's been a huge resurgence in prop trading for the individual trader, where individual traders are seeing the opportunity, particularly younger traders, the mid 20s, early 30s, are seeing the opportunity in trading futures, NASDAQ, ES, and also the opportunity in trading gold and currencies. And they're, starting to learn how to do it. And this book talks to seasoned traders who have been in the industry for, either decades and traders who have won, multiple trading competitions. We have two gentlemen who have won international trading competitions. One that's a 33-time champion, one that's a 10-time champion. We have multiple full-time traders turned fund managers. One of the guys who I really enjoyed talking to was when he was a teenager. He was one of the top ranking World of Warcraft players. And he translated a lot of those skills to trading as well. And I talked to him about that. And then we have a large number of traders who just learned to trade in the past, 3 to 7 years, who are finding success and getting funded, and also, sharing their trading tips and strategies with, people who are just starting out.
Oh, well, that sounds like an interesting book, and I will definitely look out for that. I'm sorry, when did you say it's going to be released?
So I just finished it. It's been a labor of love, and of course, it takes a couple months in order for everything to be put together. So I think it'll be ready January of 2025.
We should look forward to that. So before I let you go, why don't we just summarize what you think is going to happen this week and in the coming months in terms of the market? So why don't we just start with the upcoming Fed meeting, and then give us your views on the S&P and the NASDAQ, and where you think they're going to go as we go into year end, and also on the US dollar and the price of gold.
Okay, so with the Federal Reserve meeting that's coming up for the meeting in July, the Federal Reserve, no changes are expected. That's pretty much a given. So what the Fed says will be so much more important than what the Fed does. And with Powell, I think he's going to say and acknowledge the weakness that's happening in the U.S. economy, but I don't think he's going to fully commit to September rate cut because, as you pointed out, GDP numbers have been harder. The core retail sales numbers have been harder, and so he's going to reluctantly indicate that easing needs to happen in the late third quarter, early fourth quarter. So, in terms of how the markets will react to that, I think, the stock market will still, kind of be probably lifted by the prospect of easing. And, that's what traders are really going to focus on. Now, in terms of where the stock market is headed for the rest of the year, in September, when everyone comes back from the summer holidays, that tends to be the toughest months. September, October tend to be the toughest months for the stock market. So the markets are going to struggle. I think that's going to coincide with weakness in U.S. data. Now, whether or not it finds stabilization will hinge upon whether the interest rate cuts happen and whether there's guidance for more to come and whether we actually see stabilization in the economy. But I think the downside risk is going to be much more significant than the upside potential. And I think, you have to be very careful. Bank accounts here in the U.S. are offering 5% return on your accounts. That's a very, very attractive yield. I would consider moving some of your funds into that. And then lastly, as for gold, because, I think that the US dollar has seen its peak. I think that we're going to see more risk aversion. I believe that that's going to support gold, and it's going to encourage, an end of year rally in gold prices.
Well, that was a great summary. Thank you. And as we wrap up, if someone would like to learn more about you and your various services or even your books, where can they go?
Yes, so you can go to our YouTube channel, YouTube/BK4X. Also, I post a lot of great information on my Twitter, which is Kathy Lien FX. And you can always check out our website, bktraders.com.
Kathy, once again, thank you.
My pleasure.
Well, I hope you enjoyed that discussion with Kathy Lien. I am definitely going to check out her upcoming book, which is focused on conversations with professional traders. It sounds quite interesting. If you're trying to figure out how to prepare for your financial future, consider having a discussion with a Wealthion endorsed financial advisor at wealthion.com. After providing some basic information, Wealthion will put you in touch with a vetted advisor. There's no obligation whatsoever to work with these advisors. It's a free service that Wealthion offers to all of its viewers. Don't forget to subscribe to our channel, wealthion.com, and hit that notification button to be kept up to date on upcoming events. I want to thank you very much for spending time with us today, and I look forward to seeing you again soon.